today we are going to go over on how you can know when and where you should enter. In the previous episode, we mentioned structure. We went over structure very in depth. If we take the same exact example here on NASDAQ and we were talking about that intermediate term high, so this intermediate term high to that intermediate term low, that is our target. And we briefly touched on the short-term ranges because the short-term ranges we were talking about is exactly how you can know where to enter. Because essentially all you're doing is you're entering on short-term ranges and you're targeting the intermediate term low. If we dive into that even deeper, what we can see is if we draw our Fibonacci tool from the intermediate term high to the target, aka the intermediate term low, then these are your swing rates. We have 0, we have 0.25, 0.5, aka your equilibrium, then we have 0.75, and then we have 1. And 1 is your terminus. Terminus meaning your target, your draw on liquidity. The way we use these swing rates is very interesting because you always draw it in the right context. You draw it from the intermediate term high to the intermediate term low. Of course, if you're looking to sell, if you're looking for shorts, if you're looking for longs and you're looking for bullish price action, you would draw it from an intermediate term low to an intermediate term high. Now, let me explain the characteristics of each of those levels. 0.25 is where you will have a first entry. Likely some kind of ST entry happens around that level. At 0.5 is equilibrium, which means that at equilibrium, price is not in premium and it's not in discount. So what you can expect there is you can expect, first off, a consolidation. Second of all, a liquidity sweep. And third of all, you can also expect a new entry at that level. Then the 0.75 level right here, that is where you can expect another entry. But that is the area where you would not expect a huge retracement anymore. So if we are close to the drawn liquidity, and we can define close to the drawn liquidity by having the 0.75 level on our chart, then we are close to the drawn liquidity. We would not always expect a huge retracement into an overlapping PD rate. That is exactly what we talk about in the fair value gap video, where if we are close to the drawn liquidity, you would not expect a huge retracement and you could only expect just a sting into a fair value gap. That is usually what happens at the 0.25 level and the 0.75 level. At those two levels is where you could see just a sting into a fair value gap. And the 0.75 level is where the silver bullet entry happens. So with these characteristics that we now know, we can get very accurate with our entry and we know what we can expect, and that is very important. So for example, if you always want to trade at the 0.75 or you always want to trade a silver bullet entry, then a mechanical step for that would be is you have your intermediate term high, you have your intermediate term low, aka your target. That is your context. Then you have the context. The next step is drawing the swing rate. You wait for the 0.75 level to be hit and you enter on the first fair value gap that you can see. And that's it. Target, intermediate term low. That is your silver bullet entry. That is exactly, and for each of those levels, you can get a very mechanical guideline. But just to show you the fractality of this, let's zoom in on this liquidity sweep. Why is that a liquidity sweep? Well, what are the characteristics again of the 0.5 level? Once we trade into that 0.5 level right there, we can expect some kind of consolidation, some kind of liquidity sweep, and then we continue lower. And we can also expect an entry. Now let's zoom in on this liquidity sweep right there. Here we are on the 1 minute time frame. Now, if we take the trading plan, the time trading plan that we mentioned, where you just use the 1 hour and you have a 1 minute or 5 minute entry, then right here, you would wait for 9:30 open right there. It stings into that high. Again, do we need to know that? Do we need to know exactly where it comes into, from which premium rate it had to lower from? Yes, of course, that's helpful. But if you use this particular trading plan, then time will tell you into which premium rate will sting into, because there's no entry opportunity before that. The entry opportunity happens after that, so you react. Same exact premise, it's just fractal. You have the intermediate term high that is being formed right there, and you target what? That intermediate term low on the 1 minute right there. So what do? You draw your Fibonacci tool from that intermediate term high to that target right there, which is the intermediate term low on a 1 minute basis. Then you can see the first entry, the 0.25 level right there. Once we trade into that, again, when I say we are trading into that level, if we just cross that level, so we just trade below it, or of course, if we're looking for high prices, we trade above it. If we just cross that line, then that's exactly when you can expect some kind of entry, whatever occurs right there. That is where you have the first ST entry, a very early entry right there. Again, same target right there. Again, if you're reacting, that might be a too early entry for your liking. Perfectly fine. Afterwards, if we follow structure, because what you're doing is you're not just entering based off the swing rates. No. Keep in mind the structure that we're using. Then right there, that swing high is now what? A short-term high, aka this is your short-term range. Then we reach a 0.5 level right there. Once we reach that 0.5 level, what can we expect? That is where you usually see a bigger retracement than on the 0.25 level and a bigger retracement than you would see on the 0.75 level. And liquidity sweep and some kind of consolidation. Here we have above that high some kind of liquidity sweep, and you can see it's taking way longer. Count the candles. How many candles are in here compared to your 0.75 level and compared to your 0.25 level? Way more candles. In there, at the 0.5 level, you can again, just like the 0.75 level and just like the 0.25 level, you can make a mechanical trading plan around it. Because you could say, all right, I do the exact same. We have our context, we have our premium array, we have our context from the intermediate term high to the intermediate term low. Context, next step, swing rates. Next step, again, short-term ranges. You use the short-term ranges. Once we reach below the 0.5 level, we enter on an overlapping PD array. So what would you do? You use that low right there overlapping with that fair value gap and you enter off of that. Where does your stop loss go? Above the short-term high. Why? Because based on structure, these short-term highs should now hold until when? Until we reach the target, the intermediate term low. So you already know your stop loss based on structure. You already know your target based on structure. And you already know your entry. Based on structure alone, you can already get to an entry. With the swing rates, you can define it even more. More advanced entries for the certain levels that we are working with. So here, entry, target that, beautiful. But again, still that might be a little bit of a too early entry for your liking. Perfectly fine. Then what is the next protected high? Well, we already have that high with that fair value gap lower. Remember what I talked about in the previous structure video? If we have that fair value gap lower already, then that is already your new short-term range. So this fair value gap is already an entry. Then that right there is already your stop loss level, because you can see this as an ST entry in the middle of the leg. In the middle of the leg lower, we have another ST being created right there. And then again, same target, that intermediate term low. And then what happens? We have this new high. And then what do we see? Now we reach the 0.75 level. Now you can see I ignored the 0.75 level because we first had that 0.5 level and we didn't have any consolidation yet. We didn't have a liquidity sweep yet. So in that case, I ignore that we reached the 0.75 level and I wait for something to set up here. And then once we reach the 0.75 level again, then it gets activated. What did we talk about just a few minutes ago? We made a trading plan for what? For the silver bullet, for the 0.75 level. This right there could be your entry. And you could place your stop loss here, but for your silver bullet, it usually is close to the drawn liquidity. So to make the RR worth it, you can indeed have a more aggressive stop loss. Why? Because the 0.75 level, you are not expecting a huge retracement. You're expecting a sting into a fair value gap and then we continue lower. Again, to be a master of that, you need to practice that. Don't just blindly place your stop loss everywhere. We will have a specific video about stop loss placements as well. So right here, we got to a trading plan for every single swing rate level. And you can see that we could have entered on the 1 hour as well. And we used the fractal nature of the market to even go into the 1 minute. All right, here we are on USD JPY. And if we now get to a context again, I think you all may know the context by now, but we came into that monthly order block right there. Then the next target on a monthly basis is, of course, that high right there. So if we zoom back into the daily time frame, then we can see that that already gives us our context, because we're moving from this discount array on a monthly basis to that premium array, that first premium array on a monthly basis. And that creates this intermediate term low to that intermediate term high right there. So what do? You draw your swing rates from that low to that high right there. And you go over the exact same things. So right here on a 0.25 level, you can see, all right, we didn't do that much. Maybe on a 4-hour basis, we had a nice entry. You can definitely see that once we reach the 0.5 level, we have a huge retracement. On the 4-hour basis, what is that? That's a huge liquidity sweep that is happening right there. And then we continue higher to the 0.75 level, where we now have what? This first fair value gap getting respected, and then we continue higher off of that, aka your silver bullet setup. So this could even be your entry on a daily time frame. Now let's use the same exact example that we used in a previous video about a New York strategy. Here we are on the 4-hour time frame. Now here we have that daily fair value gap to work with. We have this new 4-hour fair value gap right there, that ST. Then if we dive into the 5-minute and take a look at that price action right there. On a 5-minute basis, we can see that we are coming into that 4-hour fair value gap right there. And here again, we are using the same exact steps. We draw our swing rates from that intermediate term low to that intermediate term high. Then we have the same levels. So now the levels are inversed. We have 0, 0.25, 0.5, 0.75, and of course 1, terminus. What happens at the 0.25 level? Not too much, to be honest. There's no entry there. All right, perfect. No entry there. No worries. Again, trading plan is about picking your poison. So we might miss a move there. Perfectly fine. What happens after? 0.5. We see the most price action right there at 0.5 again, where we have some kind of consolidation because we have a lot of price action right there. It's at equilibrium. Afterwards, we see what? We see again a nice trading setup. We first off have this trading setup, but if you want to enter an overlapping PD array, then yes, you might have missed the entry there. Perfectly fine, because an entry after that is right there. It's exactly what we went over with the perfect entry. That's right there with the same mechanical steps to go over. And then afterwards, we reach the 0.75 level. So now we know, all right, that could be our silver bullet. So we want to enter on the first fair value gap right there, which is right there. And you can see it didn't reach into that overlapping PD array because at that moment in time, it doesn't have to anymore. With that as target, or of course, you can even target higher. You're not restricted to just that target. And that is exactly how you can form a mechanical trading plan using just structure. Now you could just make a trading plan without the swing rates, just using structure, but you can also use the swing rates because they give you a guideline. They can give you a mechanical guideline because we can make different rules for every single level, for 0.25, for the 0.5, for the 0.75. Pick one of them. Master one of them first. And then after you can incorporate other levels. Please pick one first. Master it, study it, and stick to it. And by the way, look at how beautiful the fair value gaps are telling you a story right there. Again, the overlapping high with that fair value gap getting respected and it's displacing higher. Just a reminder, enrollments of the masterclass are opening up on the 25th of August. So that is this Friday. Limited spots are available. There are only 3 spots left. So if you want to be a part of that, if you want to be a part of the money making team, it's called the money making team for a reason, because the students, excluding me, have racked up 1.4 million plus in assets under management in a very small amount of time. And then again, if you haven't watched the structure video, I would highly advise you to do so. And if you have watched it, please give it a rewatch. And the fair value gaps are telling you a story video is also very important to rewatch, because then the whole story, the whole A to Z guide makes more sense the more videos there are, because they are all connected in some way or another. All right, perfect. Thank you.